All right, welcome to the Transformation Perspective. Happy Friday, everybody. Today is episode 5. We're going to try to wrap up the economy issue today so we can move on to the second issue of immigration for next week. So today's episode is called The Middle Class: Inflation, Wages, Corporate Profits, and Taxes. It's a fatal four-way match today. So let's get to the headlines. Once again, I'm your host, Harper. So in the past week, Vice President Harris picks Minnesota Governor Tim Walz as the running mate to be the VP candidate. The pick seems to appeal to Midwesterners instead of going with the Josh Shapiro governor from Pennsylvania to win that swing state for Democrats. So the appeal is more of a Midwestern pick, someone who is not really well known in politics right now. The background of Tim Walz is he was a social studies teacher, a football coach, so very much middle class before he got into politics, I do believe, in 2006. So now we have a Harris-Walz ticket and a Trump-Vance ticket going forward. And so we're off on the running here, everybody. November 5th is less than 3 months away, so the election is coming. Other headline news for this week: the U.S. stock market had a major drop on Monday, response to Friday's job reports. We talked about this in the last episode of the jobs reports of 114,000 jobs being created in the last month, and unemployment rose to 4.3%. This spooked the markets, and spooked the investors, and a massive sell-off. So once again, fear of the unknown, or in this case, the uncertainty of the slowing of the economy, is a primary cause of the drop in the stock market. All right. So once again, fear drives a lot of things, everybody. We get scared because of some unknown factor. So we're freaking out about the economy. So we start selling off our stocks left and right. And then everyone really starts to freak out. That's not what we want to do. Okay. Don't push the panic button just because a jobs report came out. Right. So how both parties are going to spin this, how the market kind of spooked a little bit, and how the market might bounce back after that, how the Democrats and Republicans are going to spin this is going to be interesting going forward. The Feds have chose not to lower rates. They say they're going to raise rates in September, but it looks like maybe more than that. Or not raise, my bad on that one. Cut rates by 0.25% in September. So they might cut rates more drastically because of this spook and oh man, the economy's not doing so well. The economy's doing still really well. Like our GDP, our gross domestic product, is up 2.8% in the second quarter. So that's really good. It's just everything else isn't. And that's what we're talking about this in these episodes. So let's find a positive fact in the higher interest rates, because that's what everyone's so down about. Oh, our borrowing capability. There's always a positive and a negative, right? So everyone talks about the higher borrowing rates, but what is also true is you actually have higher rates of investment in your savings. This is the time to open CDs, right? This is the time to open money markets and start saving money if you're not really into the stock market. These are simple ways to gain a lot more interest. It doesn't combat inflation as well as investing in the stock market, but they are higher. So take the opportunity, invest a couple dollars, open CDs, open money markets. All right. And lastly, Trump proposed this week in a press conference that he wants to do more tax cuts if he gets elected. We kind of briefly talked about that, as well as cutting the corporate tax rate from 21% to 15%, not taxing Social Security. So these are all, once again, going into the election year. So let's dive in to this episode then. We're talking about those tax cuts. We're talking about those corporate tax rates. And let's look at inflation from the get-go. So, quick recap of the last two episodes that we talked about the economy. Wages and rent was episode 3 that we focused on, and how budgeting costs and the concept of that versus the rent just does not work out. Rent is way too high. So the value of the dollar is per $100 spending is not super great, as well as those high rent costs that you got. Last week's episode, we compared wages from 1968 to 2004, adjusted for 2024. My mistake, adjusted for inflation. So now we're looking at inflation as a whole. So inflation, wages, and the economy is the number one issue for America this election cycle. So concerns for Americans in the rise of standard living costs is the primary thing. So if you don't know what standard living costs, this is healthcare, transportation, like high gas prices, groceries, childcare, utilities, housings, and et cetera, right? A lot of things that are out there. So just your normal living expenses that you might have from day-to-day aspects. So from a source of Economic Policy Institute, from January 1st of 2019 to April 4th of 2024, inflation on prices have risen by 26.27% in that time span. However, remember, they calculate inflation based on 12 months previous from when the data is collected. So really, you're looking at numbers from January 1st of 2018 to April 4th, 2023 for those. So inflation of prices have risen about 26%. That is an average of 0.41% of inflation per month on our cost of living goods of standard living costs. Your nominal wage, this is your wage not adjusted for inflation. So from January 1st, 2019 to April 4th of 2024, the nominal wage has increased by 27%. Yay! It went higher than inflation, but not by much, everybody. So that is a growth of 0.42% in growth in wages per month in that time period. Now let's look at the real wages, which is the adjusted for inflation on your wages. Yeah, we've talked about wages for the last 2 episodes. So let's look at it. So in that time span of January 1st, 2019 to April 4th, 2024, real wage growth has been increased by 3.6%. That is astounding, right? 0.05% growth per month. Wow, if you adjust for inflation. No wonder why Americans are hurting. No wonder why Americans are saying the economy is not doing well. Our wages have not kept up. Yes, our wages have increased quite significantly since the pandemic to combat that inflation of cost of goods, right? But overall, no. We feel like we still aren't beating out inflation. And this is what's the driving factor of why Americans think the economy is doing so poorly. But if you look at it from the economic standpoint, like the GDP and profit sharing and everything like that you've got out there, the economy is doing really well. Unemployment is still really low, 4.3, the highest it's been since October of 2021 during the pandemic. So if you really think about it, it's like, yeah, we're doing well. It's just the wages of how much the value of our money can actually buy on our standards of goods that we have out there. If you're watching not on YouTube, the rest of this can be found on YouTube. Just follow me, look up Transformation Perspective anywhere on YouTube. So let's go in and look at corporate profits, right? Because that's always fun, right? Because we should be able to see the fact that since 1968 to 2024, corporate profits, I broke it down per 14-year increments from 1968. So since 1968 from quarter one of 1968 to quarter one of 1982, corporate profits were at $58.82 billion. Remember, the highest corporate tax rate in American history was during 1968 at 52%. So in quarter number one of 1982 to quarter number one of 1996, there was a corporate profits of $181.46 billion. From quarter one of 1996 to 2000. Oh, wait, never mind. I read that statistic wrong. So in 1968, there was a corporate profit of $58.82 billion. In 1982, there was $181.46 billion profit. In 1996, that was $537.204 billion in profit. And in 2010, it was $1.57 trillion corporate profit. And in 2024 of quarter one, there was a $3.168 trillion corporate profit. It's a lot of money. But remember, we talked about wages that first time, episode 3, and then we followed up in wages in episode number 4 for adjusting for inflation. Yeah, we definitely didn't see that kind of growth. We actually saw a decline in our wages adjusted for inflation. So let's look at the percent increase that you've got. So in that 14%, 14-year span of 1968 to 1982, the corporate profits increased by 208%, or roughly 208.5% increase in corporate profits. They had a 52% corporate tax rate that got cut down to 46% corporate tax rate, and there were 3 recessions during that time period. From 1982 to 1996, the corporate tax percentage increase during that time period was 196.04% increase in corporate profits. There was a tax cut in 1986. There was a tax increase in 1993. The corporate tax rate went from 46 down to 34 and then back up to 35. And there were 2 recessions during that time period. This is all giving you context of what was happening in the economy. 1996 to 2010, there was a 192.35% increase in corporate profits during that 14-year time span. There was the President Bush tax cuts in 2001, and we had 2 recessions, and one of those was the Great Recession. And then 2010 to 2004, corporate profits were at 101.723% increase. We had the renewal of the Bush tax cuts. We had the Trump jobs and tax cuts. And we also had a pandemic during that time period. So if you look at it, yes, the percentage has decreased, all right, in rising of the profits. However, the overall increase in corporate profits from 1986 to 2024, get ready for this because our minds are going to be blown what the corporate profits have done. 5,286.25% increase in corporate profits in that time period. Okay, so when you adjust that for inflation from the 1968 number, what did I say, like $58.8 billion profit, we adjust that for inflation and see the percent growth. Corporate profits have still gone up 484.61% from 1968 to 2024. That is a huge jump. You're thinking, wow, what about the American wages? Let's bring those in from the last 2 episodes. So when you look at American wages, not adjusted for inflation, so we went from $7,700 we're making per year to $6,200, $62,000, let's say, in 2024. So from 68 to 2024, you saw a percent growth in American wages in the middle class by 705.54%. Seems great, but compare that to corporate profits. Where the heck is the middle class wages growing? Oh, that's right. We talked about that. They have decreased in that value of time. The wealthier have gotten wealthier, and the middle class has actually gotten poorer based on the value of the dollar for American wages in the middle class has actually gone the opposite direction. When you adjust it for inflation, get ready for this. When you adjust the wages for inflation, in 1968, it comes out to be about $72,000 you're making, and 70, I think it was around $70,000, $72,000 per year. Now it's 62,000. So from 1968, adjusted for inflation, to today, we have seen a decrease, a negative 12.5% decrease in American wages, adjusted for inflation, since 1968. But corporate profits have gone up 484%. They have definitely not given their employees the fair share of the profits they got to pay them and say, hey, thank you for helping us make profits. So we're going to help you out by boosting your wages. I looked at this. Look back at my 2 episodes. I showed you that. Our wages have technically gone down when you adjust for inflation. They have not grown. Why does America today, going this election, think that the economy is doing so poorly? Here's another reason. Our wages haven't grown. So now the question is, we always have to point the finger. Who do we blame? Is it the Democrats? Is it Republicans? Is it corporations? Is it greed itself? Oh, good old greed, that good friend that we love so dearly. So let's look at this. There we got. Let's look at tax cuts that happen. So how do these corporate profits have gone up with tax cuts? That's one anomaly that it's in there, that factor. Obviously, with innovation of technologies, global markets being open, those are other contributing factors. But let's just look at one thing: tax cuts. Specifically, more of that corporate tax cuts that you've got. So, what exactly is a corporate tax that you've got? So this applies for corporations' profits that you've got. These are taxes that are paid on companies' taxable income, which includes revenue minus expenses. The main expense a company has is usually the employment, right? Then you have other costs that you've got for fixed costs, that you got variable costs, cost of operation. There's a lot of things that go into that. Right. But the big cost that you've got is employment that you've got on there. So then they pay taxes on their profits that they've got. So corporate tax rates can also be lowered, that we're right now at 21%, through a few following things. You can lower that. Hey, we're not going to pay 21% as a corporation. There are other deductions that they can take off. Government subsidies. Oh, yeah. And the tax loopholes that they've got. So with this, they can lower their corporate taxes that they pay in to the federal government as revenue. And therefore, the government has less money to spend. But we keep spending tons of money. All right. So the federal revenue is driven by wealthy and profitable corporations. Yeah, the more money they make, the more money they pay in taxes. And then we have money to spend on roads, education, our defense spending for our military, all those things, right? Our GDP, where's all our money going to go to, and all our budgeting aspects, right? Here's the thing, though. Republicans have now advocated this year, last year, going into this election year, for cutting spending. We have to cut spending. Look what we're doing. We have a $35 trillion debt. We're spending too much, right? However, they are also the ones who also keep asking for tax cuts. Right? They want to cut taxes, but then they don't ever cut spending. Now they're claiming we got to cut spending. We got to cut spending. But Trump is proposing a tax cut on the corporate tax rate from 21% to 15%, do another big tax cut, renew his tax cuts, and tax cuts again on top of that. Where do we have money coming in to fund the government? We keep arguing over government shutdowns because we can't get a budget passed. Okay. Before we get all crazy about this all, let's really look at this aspect here, right? So from a source of American Progress Report, source that I've got, with Bush's tax cuts in 2001, the renewal of Bush tax cuts in 2010, Trump's tax cuts in 2017, the national debt has gone from 5.5 trillion to 35.1 trillion currently in 2024. So let's look at some presidential time periods. So Bush served for 2 terms, 2000 to 2008, and the national debt was added by $6.4 trillion. Under Obama, in 2008 to 2016, the national debt rose by $8.9 trillion. There also was the Great Recession. During Trump's administration, 2016 to 2020, the national debt rose by $7.7 trillion. Okay, so that's a 4-year time span. Bush and Obama were 8 years, right? Biden, so far, right? And 2024 is not even over. We have spent a national debt increasing by $6.6 trillion. However, the pandemic and recovery was during that time period. So if you look at it, like, yeah, Trump cut taxes, but also spent the most money in the shortest period of time since 2001. Claiming we had the best economy, claiming you had the best wages, but the national debt rose. Okay? So tax cuts are estimated to have 90% increase in the debt ratio. But if you take out the Great Recession and pandemic spending. So let me re-say that. I kind of stumbled over that. So if you take out the Great Recession and the pandemic spending that goes on the national debt, 90% of the national debt is because we have cut taxes 3 times in 23 years. That is mind-blowing. All right. So let's rewind the clock a bit here in history. From post-World War II spending, obviously there's a lot of spending going on, try to win the war. In 1946 to 1980, so in 34 years, the federal debt declined from 106% GDP. Remember, we were wartime spending, trying to also get out of the Great Depression, right? Down to 25%. Not bad, right? Hey, there we go. Okay, so because of that, there's 2 reasons for that. We had government-ran surpluses. Say that again. Surpluses? What is that? Right? A surplus in this day and age? Yeah, that let's just laugh about that. That doesn't happen because the last one that happened was 2001, right? Under Clinton and Clinton leaving office. The other reason why we dropped that debt ratio is economic growth rates exceeded the Treasury interest rates. So, like right now, the federal interest rates, I think, are what? 5.25% to 5.75% or something like that. So if our economic growth is higher than what the feds have marked at, we can drive down our debt. We can get a surplus. That's a good thing. Think about Americans and their money. If my monthly expenses are continuously to be higher than my monthly income, I'm losing money. A surplus is when I have more income coming in than my expenses. So in 1981, President Reagan enacted the largest tax cut in U.S. history. This reduced the federal government revenue for the next decade by $19 trillion. Yikes. Right? Clinton in 1993 proposed raising the taxes. This created the last federal surplus in 2001 at $230 billion. Interesting. Taxes are a short-term investment. It gets you the money that Americans want right now in their pockets. However, the long-term investment, remember we talked about that in previous episodes, how do we invest into Americans' futures? The long-term investment has caused negative effects on American wages. The massive tax cuts that we have done since Reagan, cutting the corporate tax rates, cutting taxes for the wealthy, have drastically hurt the middle class wages. Why today in 2024, Americans think the economy is doing so poorly. So what do? We point fingers. Trump is pointing like, I had the best economy. What's up? And then he points like, oh, look what Biden did. And then Biden's like, well, I came out of the pandemic. And now Harris says, we had to come out of the pandemic. Yeah, we got to look at lag time in previous administrations and what it keeps causing this problem, right? Here's a quote for you. Unquote, the U.S. doesn't have a high spending problem. It has a low tax problem, end quote, right? So the U.S. ranks 32nd out of 38 nations in the Organization for Economic Cooperation and Development, the OECD, in tax revenue. Yikes. Okay. So the U.S. is not even close to the OECD average over the next 10 years. Even if we got to the average, we would still be $26 trillion less than the average over the next 10 years. Add that in, we have a shortcoming of $36 trillion to the EU in tax revenue. Yeah. Okay. So tax cuts mainly benefit the wealthy. However, propaganda spins it to benefit the middle class because wages will increase. 3 lessons, 3 episodes. I've shown you the statistics. That is not the case. It sounds great. It does. Everyone loves tax cuts. Everyone dreads this. We're raising your taxes. Unfortunately, we're at that moment where we're probably going to have to do that because this is not working out the way we keep running this. Cutting taxes and keep spending, there's no way the government's going to stop spending. Have the wealthy pay their fair share. The U.S. is also competing with foreign markets to keep business in the U.S. by having lower tax rates. However, at what cost does this have for American wages? Since the global markets really opened and opening into China and all the markets in around 1997, our wages have really drastically declined. So in closing here for today's episode, let's tie this back into the beginning, the social contract theory. How can we benefit the community as an entire whole, and you can still benefit as yourself in a capitalist society? We've gotten away from that. We have look at that, 5,200% corporate profits, right? Our wages have declined, right? What has benefited us as Americans? No, it's starting to benefit individual companies more than the people that are working for those companies. And how do tax cuts and the invisible hand, which is the invisible hand is how it benefits the community and oneself? What's the long-term thing for that? How do we make the economy better? Through our wage growth. There are a lot of questions here that need to be answered. 2 choices right now. Harris, Trump. Trump wants to cut more taxes. Harris hasn't proposed what to do. All right. Right now, I still don't feel confident in either one of them, to be honest with you. However, after looking at my statistics and data, I really don't want Trump back in for cutting more taxes. Where are your wages going to be then? Adding in tariffs as well. This has been episode 5 of the Transformation Perspective, the middle class, inflation, wages, corporate profits, and taxes, right? Share this, like it, subscribe, and also get out and vote, right? Primaries are going on right now for House, Senate, governor races, state amendments that are going on for constitutions, other local races that are taking place. Please get out and vote. Early voting starts really, really soon. Have a great weekend, everybody. We'll see you next week.